So far, we have learned that it is very rare for a price to move in one direction for a longer time. Surely, when there is panic or euphoria on the market because of some big news, prices may skyrocket and it is hard to enter the trade. In most cases though, the price moves in zigzag shapes. Some traders call it waves, and there is a scientific concept called Elliott wave theory. But for us, it is important to know the nature of these moves. First, we need to identify a swing move that is a move from point A to point B. We know already that after the main swing there should be a correction in the opposite direction to point C. When we see a move from point A to B, we wait for a move down to point C. Point C should be located between points A and B. On a chart illustrating an uptrend it may look like this. It is not always so easy to identify points A, B, and C, but it gets easier with time and experience. When we are sure that we have found the A, B, C move, we can draw a Fibonacci retracement with a tool from our chart software. We start from the low of swing to the high, so from point A to point B. In candlestick charts, you should draw from the low of the shadow, or peak, of a candle to the high of a candle. Please notice that you get much more accurate results when you apply the retracement levels to your candle chart rather than line chart. How do you know if you have chosen the right top and bottom? It is a little bit like art, and comes with time. At times, when you have two bottoms nearby, even if you have selected the wrong one, it is not going to change the position of the retracement levels so much. Just practice on the price history. This is always a problem for new traders. They think that the retracement to point C is only valid when the price touches down this level. They are wrong. Fibonacci retracements are a great tool, but there is number 100% accuracy. Sometimes the price closes near the retracement level, and it can be still a valid move. Just look at the example below. In a downtrend, there was a correction up. The price looked as if it would move up to 0.618 retracement level, but it did not happen. The result was that candle closed below the 0.5 level. Still, it is a valid correction to point C, and then the price moved back to a downtrend. Try to pay attention to this. On numerous occasions the price will almost touch your retracement level, which is great. However, be aware that sometimes the price only draws near that level, and still trading is worth continuing. What retracement levels should I use? It is very confusing at the beginning, because there are many Fibonacci retracement levels, and some people use only specific ones, while others like to draw all the retracements. My advice is to try to use the standard levels. Over time, when you gain more experience, you will decide which are the most important ones and which ones you prefer to use. So, which levels should you start with? 23.6%, 38.2%, 50%, 61.8%, 78%. Why use the 50%? It is not a Fibonacci retracement, but still an important level, halfway up or down. So traders like to keep this retracement level together with other proper levels. Stick to these levels, and it should be enough to trade well when it comes to price correction. I have my retracement lines. When should I open a trade? Now you know how to draw the retracement lines. Thanks to them, you can enter a trade with a better price, which is always a good thing. But when should you enter a trade? That is the biggest challenge after drawing the right retracement levels. After drawing the retracement levels, you should decide when you want to open your position. We have confirmed that the main trend is strong and is up. After a swing move from A to B, there was a strong correction, so we have drawn the retracement levels. We are waiting to take a long position because the main trend is up. Personally, I don't enter a trade only with Fibonacci confirmation. Of course, I use a lot this tool as a confluence to my trade setup. Now we have 3 options of doing this. First option, you are willing to take bigger risk in turn for a possible bigger return. When the price almost reaches the 50% retracement, you go long at this level or a little bit above it. This level is very popular among traders, so, very often, at least for a moment, the price stops here and bounces back. You can take the same action at 61.8% or 38.2% if you think that the correction ends and there is your point C. Remember, this may not be a bounce to new highs. You do not have the knowledge about it at the time of trading. Having seen the right side of the chart, and you know that in that case the correction ended on the 50% level. In real life, when you choose this option, you never know if the correction really ended at point C or it was just a false move. But if you are right, your possible profit can be very big. The second option is when you wait and watch how the price reacts towards the retracement levels. If you see that 50% is probably the retracement which a bounce back may occur from, you are ready to take a long position. But unlike the first case, you wait for another confirmation. It could be many things, such as a candlestick, a small double bottom, or simply something that is written in your trading plan. When there is a confirmation signal, you go long. Of course, confirmation signals are not always 100% correct, but in that case you have lower chance of failure. This, in my opinion, is a better way to enter trades. The ratio between risk and possible profit is very good. In this example, the trader decided that the signal will be a breakout of price above the trend line. As I have mentioned, you have to decide and test yourself what signal works best for you. In the third case, you wait until the price breaks above the recent high, the one you have used to draw your retracement levels, point B. Where to put stops? The Fibonacci retracements are great when it comes to placing stop losses. Let's assume that you have a long position opened after a correction to point C. Where should you place the stop loss order? I like to put it below point A, that is, below the place where the swing move started. If the price moves back down below point A, there is probably something wrong with the trend strength. It all depends on how aggressive you want to trade. Sometimes I place stop loss just below the 78% retracement line. If you want to place a tight stop loss, you place it below the retracement that you think is your point C. The good thing is that, over time, you will understand the behavior of the price better and you will be able to place the stop losses in better places. As I said, I don't use just Fibonacci in my trading plan. Before putting the stop loss, I check other factors too, like support and resistance, supply and demand, and others. The retracement and trend lines. Sometimes the price trends very nicely and it is easy to see the trend line. In such a case, there is a strong chance that when it comes to a correction, it will end at a Fibonacci retracement level closest to the trend line. Fibonacci works great on the trending markets, so it is a good idea to combine these tools. First, you have to draw a trend line. Let's assume you are waiting for a retest of this line. In the meantime, You can also draw the Fibonacci retracement levels from a low to high swing. Let's assume you are waiting for a retest of this line. In the meantime, you can also draw the Fibonacci retracement levels from a low to high swing. The correction ended at the 61.8 retracement level and the price touched the trend line. As it turned out, it was a great point to enter the trade. You can play this scenario by entering the near retracement level and trend line. You put your stop loss below the trend line, but not too far from it. With a strong trend in place, you assume it is a low-risk entry. It does not always work this well, but sometimes it does. You have to be very watchful about these kinds of price behavior, because these are good points to enter a trade. The potential risk of loss is small, and the potential profit is big. The Fibonacci retracement and support and resistance. Another great way to predict where the price move might end is combining the retracement lines with support levels. It is very simple to do. First, you have to check if there is any important support and resistance level. We look for a few types of support. It may be support from previous important highs, like in the example. Let's say that we want to take a long position after a break above this resistance, so we'll look for a trade in the area near the right side of the chart. On the lower time frame we can spot swing and correction very fast, down to the 61.8% retracement. If you take a closer look, the correction ended almost exactly at the support. Some traders probably took long positions, only because price moved back to the support line. But you know, with your knowledge about Fibonacci, that when an important support line is in the same area as the retracement level, then it is a trade you should consider to take, because there is a much better chance of success. The Fibonacci projections. In this part you will learn about the Fibonacci projections and how you can use them to choose your exit point. This is another great tool which can make you a very effective trader. When do you take profits? There are two similar tools to project where the price move can end: the Fibonacci extension and the Fibonacci expansion. It is confusing at the beginning, but I am going to explain the main differences so you can have good understanding of the subject matter. Why are the Fibonacci projections so important? I have seen many cases when people opened the trade at the right moment. For the next few hours or even days the trade was profitable, but they hesitated to close it and ended up with a loss. The most important thing to remember is that you earn money when you close the trade and book profit from it. If your position was opened 2 days ago and it is profitable, then good for you. But until you close the trade and take the profit, it is virtual profit. It changes all the time. There might be some big news, the price will move against you, and in a couple of minutes you will be counting how big your loss is. This is the reason why closing trades is so important in trading. For me, closing trades is far more important than opening them. Even a poorly executed trade can turn out to be profitable if you exit at the right moment. But when is it the right time and place to take the profit? The Fibonacci projection is very helpful in solving this problem, and I am sure you are going to enjoy it. The first tool is the Fibonacci expansion. Let's start with the Fibonacci expansion, which is based on 3 points. To draw it, we have to identify the swing and correction. Yes, it is exactly like it was with the retracements and looking for points A, B, and C. We use the same A, B, C points. As you remember, we have to identify the swing and correction. Points A and B are marked at the swing ends. C is at the point where the correction ended. How to draw the expansion levels? In TradingView platform, choose Trend-Based Fib tool. Run a trend line from point A to point B. Next, you have to click on the end of the second line and move it to point C, where the correction ends. Now you have the possible levels where the move may end or stop for a while. Most popular are 0.6181, 1.272, and 1.618. How is it calculated? The expansion levels are drawn from point C. Target 61.8 is 0.618 times of the distance between points A and B. Target 100 is 1 times of the distance between points A and B. Target 161.8 is 1.618 times of the distance between points A and B. That is why in the above example the first target, 61.8, is below point B. The correction was deep. The 61.8 target from point C ended below point B. Why? Because there ended the 0.618 distance between A and B. In another example we will try to find the expansion in a downtrend. First, we need to make sure that the downtrend is strong, and then we wait for a swing up and a correction to C. We start from drawing the expansion from A to B. Next, we move the second line to point C, where the correction ended. The expansion levels are now drawn correctly. In this example the price moved down to the 161.8 expansion. It gets easier when you practice it yourself. Remember, you have all this historical data to practice with. The second tool is the Fibonacci extension. The Fibonacci extension is based on the first move, from A point to B point. Point C is not used for calculation here. The extension levels are calculated basing on the distance between points A and B. The levels are drawn from point B. For example, the 1.618% extension level or minus 0.618 retracement is the same thing, is equals the 61.8% distance between A and B, which is drawn from point B. Look closely at the chart, where I marked the distance. Now you can see that point C, where the correction ends, does not matter in the calculation. We only care about the swing from A to B, and this is our base to calculate the extension lines. It may seem that this method is less accurate, because for the expansion we use 3 points. The truth is that it is also very accurate despite differences in calculation. The Fibonacci extension in practice. In the example you should be able to find points A and B. We can use them to draw the retracement levels as you remember from the previous lessons. In this case we do not pay attention to where exactly the correction ends. Point C will be somewhere between A and B, but in order to calculate the extension we need only A and B. This is what happens next. The correction ended at the 50% retracement level and the price went down to the 161.8% extension line or minus 0.618 Fibonacci retracement. Are the same thing. It closed almost exactly at this level and, right after we noticed a very strong bounce up. In another example we can also spot a correction down to the 50% retracement. From that point, buyers showed up and the price moved up strong up to the 127% extension, where it stopped for a while. Later the price moved up to the 161.8% extension, which was a very strong resistance for a long time. Actually, the price did not move above that level and sellers took control. It is important for you to understand the difference between the Fibonacci extension and expansion. Expansion consists in 3 points, A, B, C, to calculate the expansion levels. Extension consists in 2 points, A and B, to calculate the extension levels. Both tools are great. You can plan your exit points and book profits thanks to them. You can use Fibonacci expansion to define AB equals CD pattern and alternate 1.27 AB equals CD. Which extension levels are most important? There are so many projection levels that you might be confused which ones are the best in practice. Some traders like to draw only a few levels on their charts to keep things clean, but they are aware of the fact that the price might stop at other levels. The most common extension levels are 127%, 161.8%, 261.8%. It is all about probability. It is important to learn to watch closely how the price reacts with the projection levels. You do not know in advance where the price will stop. The projection levels are only levels where there is a possibility that the price may stop. It also does not mean that the move will definitely end at the projection level. Sometimes the price stops for a while, and later, if the trend is strong, the move continues. In other cases, the move will end at the price projection, and it may even be the end of the current trend. That is why you should learn how to watch for the price reaction with the projection levels and to your signals. Still, you are in a much better situation than other traders. You know in advance the possible levels where the price may stop.